unlike many other investments like stocks or bonds. Now, again, there's no infallible system. So even together, the relative strength indexes and the Bollinger Bands will produce false signals. Of the 6 signals produced by the RSI that were confirmed by the Bollinger Bands, we end up with 4 of those being false and 2 of those being successful. And this is on both on the overbought and the oversold. So there's no infallible way to trade. No one can tell you that they can guarantee you profits and guarantee you success using any indicators. But using the indicators gives you the opportunity to see where the market is headed. And as I said before, we use a layering of opportunities, looking at the Commitment of Traders report, looking at the Bollinger Bands together, and looking at some of the other indicators layered to figure out when we should enter. 3 to 6 confirming indicators is always a great opportunity to make a trade. Here's another time where in live cattle we see a lot of movement, a lot of momentum upward, in which the 2 together produce false signals. They produce 4 good signals, which are in the green, and they produce 2 bad signals. Still, more than enough opportunities to make a profit, but again, don't trade without any type of money management, just in the event that you're wrong, or that the indicators that you're using may be wrong. Now, earlier I spoke about several of the people who are very popular in the industry and a lot of the hype that goes on in the industry. One of the people who was very successful in our industry was Larry Williams. He's been a member of the National Futures Association. He served on the board with the NFA. He's been very successful in the industry, and in fact, he's one of the few people that I definitely respect for his educational knowledge and information in the futures industry, and he also trades stocks. He's been in the business since the early 60s and has been consistent in his style of trading. One of the things he's well known for is taking $10,000 in a true trading scenario to $1 million in real life trading in the course of a year. And one of his famous books is how I made $1 million trading futures in a year. And it's got a lot of great information, indicators, and in fact, one of his indicators, the Williams percent R, is very well known, and in fact shows up on most paper charts, if not all the paper charts, in the futures industry, because it's that well effective. Now, the way the Williams percent R overbought oversold indicator works is inverted. So it really goes from a scale of 0 to 100, and it's most reliable during trending markets. So you have to use it when the market is either moving up or moving down, and you can clearly see that. You don't take opposite signals when the markets are trending in opposite directions, and we'll look at a few charts to clarify that. Now, here we have live cattle, March 2004, and we see that it's definitely in an uptrend line. And with the Williams percent R, there are 5 different points in which you have legitimate buy signals. And typically those signals have shown up when the futures market, particularly in this case the live cattle market, touches the uptrend line. Now, the way it works is 90%, when the percent R hits 90% in an uptrend line, it produces buy signals. It's hit 90% 5 different times, and definitely 5 different opportunities showed up for buying. But on the 5th opportunity, and this is where money management is important, because of the mad cow scare, and again this goes back to what we spoke about earlier, how fundamental changes in a commodity can change what's happening. When the 5th time the indicator showed an opportunity to buy, the market actually rolled over and tanked. And this was solely on the news of the mad cow scare. So who knows what would have happened and how far the market could have gone up had the opportunity been there and mad cow disease didn't show up. So it's very interesting. This is another opportunity to look at how the 90% works in an uptrend market. This is a gold contract, and again, you only trade this when the market is trending up, but when you look at it, there were 4 solid opportunities to buy gold over the course of a year. Again, not many opportunities, but you have to decide when you do any kind of trading in futures whether you're going to be a hunter or whether you're naturally just going to let the market whipsaw you and get you in and out of trades. And being a hunter, sometimes you just have to watch and wait before you take your chances or pull the trigger. And this was a great example. Gold actually continued to go up a little bit on the fourth signal, and later on pulled back. But that's what money management's for, and to protect you from indicators failing on you. So it's a great indicator in an uptrend market. Now let's look at some downtrend markets or bearish markets. This is a coffee contract, and the way the Williams percent R works is when the indicator hits 10% in a downtrend, it produces sell signals. In this instance, we had 1, 2, 3, 4, 5, 6, 7, 8 different sell signals in the course of a year. Great opportunities to participate in this market, and each one of them were pretty much on point. Very good indicator. It works in a downtrend system only when you want to take the sell signals, and it's always good to either back this up with a Bollinger Band or any other things we talked about, Commitment of Traders Report, to just confirm that the sells are right. But otherwise, very clear and very simple to use. This indicator, like any other indicator, has failures, but it's something good to use. This is an example of a sugar contract, definitely in a downtrend, and yet this indicator produced over about nine different opportunities for you to sell into the market. Now, there's no way you could have not had an opportunity to profit had you followed the sell signals. But again, it's not infallible, but I like it, and a lot of traders and futures tend to use it because it gives us an idea of what the hedgers are thinking. Those are the market makers of our industry, and they have a different view of what's too high and what's too low, and it definitely shows us when and where to take advantage of that. Now that we've covered the overbought and oversold, we have to look at how the hedgers get themselves into the market. In one example, we talked in the single stock futures contract, 13,000 contracts was considered a reportable position. In fact, it was considered a position limit. Well, how would you get into the market with 13,000 contracts? If you did it on the first day, you'd be adverse to your own movement of the market. So they have to scale in and out of their positions. And this plays back to why the Commitment of Traders Report really can't be accurate the same day it comes out. Even though the market makers or the commercials and the hedgers may be very bearish on a market or very bullish on a market, they have to scale in their positions to determine what's the best price for them, because they still have to match their bottom line. And so they do this through accumulating and slowly distributing different futures contracts. So there are two ways to catch this scaling in and scaling out. You have the accumulation distribution lines, and another form of accumulation distribution is the open interest. We'll first touch upon the accumulation distribution indicators. Now, there are a lot of accumulation distribution indicators. The one that I tend to like to use, and which is very clear and simple, is the Williams price accumulation distribution. You find it in all your charting services. And the way it works is on a divergence concept. And what that means is when the accumulation distribution line is not reaching new highs, but the price is reaching new highs, that shows that the market is beginning to be distributed. And when the market is reaching new lows in price, but the accumulation distribution is increasing in price, the accumulation line is increasing in price, then that shows that accumulation is underway, in spite of what the face value of the price may be. And let's go through some charts to clarify that.